From the morning reading, spiders, diamonds, Qs finished slightly lower on Friday, up for the week. IWM gains. 4 of 9 sectors moved higher on Friday. XLB, XLF, and XLE were the strongest sectors, while XLU was the weakest sector. Breadth weakened as advancers led decliners 1.60 to 1 on the New York Stock Exchange and strengthened on the NASDAQ, where advancers led 1.83 to 1. The spiders, diamonds, Qs, and IWM rallied for the second straight week. Spider tested Thursday's breakout of double bottom resistance at 194.58 on February 1st and closed at 195.08. Spider has a 6-week chart target of 208.07. Volume has dropped off as stocks rallied during the past 2 weeks. The textbooks and their adherents would suggest that this is a bad sign, but they rarely look at the facts. And the fact is that the stocks perform just as well after a low volume rally from a low as they do from high volume rallies off a low. In some time frames, the low volume rallies actually outperform. Small traders have a record short position against the S&P 500, the NASDAQ 100, and the Dow. As of Tuesday, they are holding about $8 billion worth of short positions, surpassing what they had last fall as stocks were bottoming. Despite that data point, overall optimism has been climbing on a medium-term basis. The index is showing a similar pattern to last October, and since 1999, when it has climbed out of pessimism to its current level, it gained over the ensuing weeks nearly every time outside the financial crisis. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:41 a.m. Central Time, and I'm recording this in preparation for the market day of February the 29th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and go to the morning report. And relatively benign for a Sunday night of late. At the time of this cut, the S&P futures are down about 3 points, just below scratch. Russell was down about 0.5%. NASDAQ is down about 1/3%, and the Dow, much like the S&P, is down just below scratch. Crude oil is right at scratch. Euro is down about a little less than 0.5%. Bonds are up about 1/4%, and gold is up about 0.75%. More activity in overseas markets as China is down nearly 3%. Hong Kong down about 1.25%, Japan down about 1%, Germany down about 1.5%, and the United Kingdom down about 2/3%. And macroeconomic reports for this week in the United States. For today, there are no orange or red flag reports. For tomorrow, and looking ahead, we have consumer confidence, existing home sales. We have also FOMC member Fisher speaking after the markets close tomorrow. In terms of current volatility conditions, obviously things after the last 2 weeks have calmed down quite a bit. The short-term VIX is a little over an 18. Skew is benign. IV percentiles on the S&P is a very low 31. On the Russell 32, NASDAQ 33, and the Dow 31. Notice that all 4 of those are in the lower third of the range for the percentiles. No standard deviation moves were put in on a close-to-close basis on Friday by any of the indexes, though you can see that we've had quite a bit of standard deviation moves being put in over the last 2 weeks. Normal would be about 4, and we're more like 6 on the S&P. In terms of the charts, let's go ahead and go and take a look at the charts. And we're going to go ahead and use the futures. We did have some overnight action, as you can see here. We're just down at this point a little bit, but in the overnight, we were down quite a bit more. At one point, down to about 1927 and change. So this is at this point up about 14 points from the Globex low. So a good bit of short activity in the overnight, though the bulls did come in and raise that up off the bottom. So in terms of our current patterns, we've had, of course, the double bottom. We had the triple top, which did break through and get a confirmed close, but then reversed and then closed right on the support line. So we can't really call this a false breakout because it hasn't actually been invalidated yet, though the Globex activity last night certainly, tickled that area. But at this point, we have to just kind of call this neutral. This isn't really a confirmed breakout yet, and it's also not a failure. So we're just going to come back and call this a neutral pattern for the moment. This could fall or break out. It could easily go either way. We just don't have enough information yet based on the last 3 days pattern to be able to give us a strong indication as to whether the market really can uphold a breakout of this former range, or if that's going to fail today and come back into the former range and kind of invalidate that. Now, we had that happen, you recall, last week with the Dow, where we did have a confirmed breakout on this day, and then that reversed, and then it confirmed back out again. Obviously, we've had some weakness since then, but the weakness has stayed above the prior range. So it's one of those things where these patterns are really quite indecisive at this point. And some of the reading I went through during the course of the weekend was suggesting a bull, what's the right word? Let's see here. A bull trap. That's the word I was looking for. That we're setting up for a bull trap, and that's where you go just far enough to make people think that it's bullish, it's off and running, they load up just to immediately be invalidated and take the action back into the prior range. So anyhow, if we're in a bull trap, we have to kind of go with the whole set of signals, and yet at the same time just be cautious. And when we get to the decision point scoreboard, this will be a little bit more clear in just a moment. Now let's take a quick look at the Russell. Russell, of course, has been improving and has been playing right at the top of that range. It has not yet had a confirmed breakout of any type, nor has the NASDAQ. So we've got the two more higher beta, more growth-oriented kind of indexes that are decidedly weaker and have not yet broken out of the range, while the S&P and the Dow, the more defensive ones, have tickled in a breakout of the range, and yet certainly haven't made any kind of real statement that they're going to build on that as of yet. When we look at the volatility, we're going to see that things have come down quite a bit, but they're still elevated. So while we're not up here in the upper 20s, and we're not even in the mid 20s, we're kind of playing around about 21 now on the VIX futures. Well, that's a long way from being down here in the 18, and you can see we've been elevated here ever since the middle of December, and that has persisted, and that's normally a sign that the bears are in more control than the bulls. Remember, bull market ranges are between 12 and 18, and especially below 15, and we haven't been below 15 in months now. So just kind of keep that always in the back of your mind. And then we'll take a quick look at bonds. Bonds, while they have come down off this 52-week high, as the last 2 weeks of the equity markets have exploded, you've had really more of a consolidation pattern with the bonds. This is clearly not totally broken down. It's just a bit of a retracement and a sideways consolidation pattern here, and could easily break out of this consolidation pattern into another leg up should we find that the indexes start to weaken. We'll also take a quick look at gold, because we've been seeing this kind of rotation to safety. An awful lot of institutional money in the last 2 weeks was not going to high flyers. It was going to places like bonds and gold and utilities and consumer staples. And as these have pulled back, as the equity markets have gained strength, it's been more of a sideways consolidation pattern than it has been anything more than that. So both gold and bonds could easily continue higher. You see much the same thing here with the utilities. This has been a safe haven status, and you know, while we did have a big pullback on Friday in the utilities, we still haven't even broken a former swing low. So this is just a higher low at this point in the bonds. And then consumer staples, kind of a similar pattern to the utilities. So these have been where most of the money has been going of late. Let's go ahead and go to the regular daily report. There are some changes here for today. We are still in a market trend intermediate term phase opinion of phase 4, which is price patterns near horizontal resistance. It's a bullish pattern. It can last for several weeks. And certainly right now, there's nothing really to say that there's any danger to that pattern as of yet. In terms of the portfolio investor posture, we have from IBD a confirmed uptrend. The accumulation distribution score in the S&P is a D-. NASDAQ is an E. That certainly is a warning flag. A GMI index is a 2 out of 6. That actually dropped a notch, and that sell signal has been in place since 1210. This signal is not quite so sensitive, and it takes a while to change. There is some movement by this author to start taking some exposure, at least from a the thought process of a counter trend trade, to where you're taking a bullish trade within a longer counter trend signal, and that is to say that the long term is still bearish, and he's still looking at gaining some potential exposure to the long side. And that is really kind of a good way to kind of put this overall situation. As we look at decision points scoreboard from stock charts, we could see that we have all these short-term signals that have all gone bullish, and yet the long term is still decidedly bearish. Intermediate term is quite mixed. So at this point, you have a market that is signaling a very strong short-term pattern, and yet it's against the backdrop of this long-term bearishness. Now, this could eventually rotate all the way up and through. Obviously, at some point, a bottom becomes the real bottom and not just a short-term bottom, and it eventually rotates up. But until we see stronger evidence of that, we have to be always kind of suspicious that we are in a bull trap, and that this is just a relief bounce, albeit in this instance a 2-week one that is a very, very strong and has gone some 140 points on the S&P, and yet at the same time it is against this backdrop of these longer term bearish signals. So it's not an easy place to be adding new exposure, and that's for sure. From a position sizing opinion, you are at 100% on the one system and at 75% on the other system. Intermediate term market posture is one of those bright areas, and look at this, it's all the way to an 88. In 2 weeks, we have gone from being severely bearish to very strongly bullish. We've literally gone from one extreme to the other side in a 2-week period. And the others, you see the Dow also the same. NASDAQ and Russell are also strongly bullish, well up over 50 now. And we've even turned that sentiment line during this last 2 weeks into a weak bullish sentiment line from where it was in a bearish sentiment line. So a lot of things have changed in the last 2 weeks. We have healed a lot of the technical damage. In terms of the strength of this intermediate term trend, you can see that it's actually still quite weak, and anything that when you get below an 80 on this indicator set up on a 5-year weekly, that is a weak bullish trend on the intermediate term. So kind of keep that in mind. Our hedge risk status still remains at level 1. We are slightly cautious We did drop this from a 1 plus down to a 1 when we did break above that resistance area on the S&P and the Dow, and yet at the same time we're sitting right there on the support, that former resistance turned support. So this is a very, very kind of neutral stance. Our hedge risk level certainly nowhere near where we were 2 weeks ago, and we need to respect that, and we need to start indeed increasing our bullish exposure, but at the same time we have to be mindful of the larger picture. So you add in positions slowly but surely. You add in positions that are defensive, and perhaps, you know, maybe your primary focus right now is in utilities and staples and perhaps gold even. It is in these defensive areas. We're also looking for a 1-to-0 ratio of low beta to high beta. So use those lower beta positions to be able to gain that additional delta exposure. If you're doing covered calls, the opinion is currently calling for a 3-to-1 ratio of in the money versus out of the money strikes. So that also tells you something about how defensive you should probably be in the current environment. Consider legging into those covered calls with out of the money puts as well, or scale into the position. Bottom line, if you use puts, make sure that you're using the position size, that you're willing to own those shares at that price. And indeed, very much the same down here for put selling. We are in conditions that are acceptable to initiate new positions, even for novice traders in both these strategies. But there's certainly a call for defensive setups. In terms of option income strategies, the VIX is still outside that acceptable window to initiate new positions for novice traders. More aggressive traders, of course, will welcome those higher premiums that come with that increased volatility. And yet at the same time, you might want to consider the position sizing that you are using and the structure of those option income strategies that you are using in case we do indeed experience the higher than normal expected delta and vega moves. You probably are going to have to deal with a larger than normal number of adjustments to your option income strategies in the current environment. That certainly is for real. In terms of our lower warnings, we're actually pretty quiet down here. We still have this VIX futures over 18. We still have the week out expected move on the S&P at well over 40, coming in currently at a 51. So those two areas are certainly flagging under the volatility-based bucket. In terms of trend-based, there's really nothing here. In fact, even some very bright signs. We have this market phase 4, the very strongly bullish, the New York Stock Exchange, new highs, new lows at almost twice the trigger level. It's coming in at 592 new highs. The intermarket risk aversion indicators are all 5 at risk on. In terms of sentiment indicators, and I've tweaked this area a little bit, we do have stocks at both short-term and medium-term relatively benign. Bonds a bit more at an extreme, and gold just behind that. Also, watch for potential reversal patterns on these. Your retail, industrials, housing, mining, basic materials, high-yield bonds, semis, and consumer discretionary. These are all from a sentiment standpoint at a very high sentiment, could be setting up for potential reversal patterns. Also consumer staples and technology. From our fear and greed index sentiment indicator, you can see this continues to climb, and it's now up to a 57 and coming up into the greed category at this point. So long way from where it was a month ago, where we were in extreme fear, and certainly even 2 weeks ago where we were still pretty extreme. In terms of sector-specific metrics, this is also new. I've added some intermediate term bullish groups, and notice where these are: consumer staples, and then this is the equal weight, gold, utilities, the equal weight of the utilities, and the 20-year bond. Those are the indexes that have come in on the most recent report as having an intermediate term bullish posture. Well, every one of those is kind of safe haven, defensive kind of status. And again, that's why I was saying that the institutions are rotating their money, and they are going to this area here. And that is a sign that, you know, we could be setting up for a potential bull trap. When the institutions are selling the Apples and the Amazons of the world, but buying utilities and gold and consumer staples, that should be something of a sign to you. In terms of other aspects of the sectors and their market posture, you can see in general in the short to intermediate term, this is in pretty good shape. In the long term, it's a more of a mixed picture, and again, those defensive sectors showing up as being the healthiest across all the different time frames. Now, on Friday's activity sector percent change, you see that indeed that we did have materials, financials, energy, and industrials is coming in with positive performance, and those actually were a bit more higher beta exposure, so there was some relief coming along in those areas that need to do well, and it wasn't just about utilities and consumer staples. You can see, at least for Friday, those actually were the ones that were performing less well. Now, on the 5-day, 1 month, things are also starting to, start to show a lot more green. And we might be seeing some signs to where money is actually starting to rotate in the very short term more heavily into these higher beta areas. We'll have to continue to watch this. That certainly has not been the trend for a significant period of time. That, or you also have to make a case that these are coming off of really, really low bottoms and had more room to play catch up. So financials on the 1 month is up 2%, whereas utilities, even after the nearly 3% drop on Friday, are still up nearly 6%. So kind of keep this in perspective. Okay, on relative rotation graph, and this will be the last thing for today. Again, utilities, the REITs, and then IYZ, which is telecom. Again, another defensive area. These are usually, well, there's only really 5 companies that really make up the telecom space, and they generally pay very, very good dividends. So when you see those 3, that's what, is in this upper right quadrant. Again, just reinforcing once again what the strength areas are. Okay, we've gone long enough today, so I'm going to go ahead and just roll through the rest of this. If you have any interest in this, just hit the pause button, get the hyperlink, and go get your additional information. Obviously, if you're on YouTube, you've got that gear setting button. There's 2 things you can do. For one thing, especially when I go up over 20 minutes, you can speed that thing up and listen at 1.5 times the normal speed. That can certainly cut down the amount of time it takes in your morning, while still giving you the opportunity to get the information that you're looking for. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and note the hyperlink down here at the bottom to take you to the full list of disclosures. We'll see you back here tomorrow morning with the Falcon Global Market Preview. Good trading.